My name is Alvin Fan. I'm the CEO of OPIM, Asia's #1 hedge fund platform. Thank you for joining us this morning. As everyone is well aware, we have a massive week ahead of us with consensus in Hong Kong. Some would call it the Super Bowl of crypto. It's really big for the city, and it's great for people of Hong Kong. This morning, we decided to start the week off for you and sort of set the primer and set the benchmark of all the side events as well as the big event that's coming up starting tomorrow on Wednesday with some very special guests. But first of all, I do want to thank everyone for joining. This is a very great representation of some of the oldest family offices and fund of funds here in Hong Kong. Thank you so much. With me are some of the breakout strategies and the managers and thought leaders in the space. I made this specifically, designed this specifically from the perspective of institutional investors coming into the space either for the first time or maybe their first allocation was so small. The question is, how do you build the strategy or allocate further into it, given now that we are, well, I don't know, some would argue we're probably even 2/3 if not more, into this bull run. So let me start with the round of introductions. I'll be able to let each of our guests introduce each other first. I'll start with Bart.
Thanks for having us, and the rest of the OPIM team, thanks for having us here. My name is Martin Green. I am one of the co-founders of Cambrian Asset Management. We are a quantitative investment firm that trades long and short dozens of crypto assets, and we've been operating since 2018.
Yeah, one of the longest track records, in my opinion, is one of the most institutional. So I'm really excited to have Martin here, and we're going to sit some game about quant strategies, systematic strategies, which is the playground we work in. Marco Lim, maybe a bit about yourself.
Hey, thank you, Elton, for having me again. We have been doing, not only panel but crypto debate for a year ongoing. Yeah, it's great that Elton always try to organize these for the industry in Hong Kong and get people to understand.
That's right. This is the Insto Fomo brand that we have been running for about 3 years. As some of you may or may not remember, we used to run a quarterly debate about different crypto topics through COVID and then live as well. Today is going to be not a debate structure, but we will structure some of the topics in a similar way for everyone to participate in. Marco, I think you're also working at SolarWind now and also looking at building your fund of fund specifically for crypto.
Yes. So when you invited me, we were talking to Cambrian because of the fund of fund as well. I've been trying to do this pre-FTX go up. That didn't happen. And just so I think now is a better timing with the infrastructure, and which we will dig deep on, why this is a good timing to launch it. I think it's good timing too. I'm seeing more allocations, but because from my background, I used to run my capital together with the other two founders as well. We have one of the longest track record under SFC for managing crypto as well. We're still running the fund today. We have gone through a few bull and bear cycle. So from my perspective, I do understand, what the manager is looking for. At the same time, what the LPs are looking for. To launch this fund of fund, it was coming from the ideas that people wanted to be more diversified in different strategies. And I think with meme coins, DeFi, RWA, now there's evolving more strategies. And with SolarWind, which are a Nasdaq listed company that focus on now building Web3 before they mainly focus on US IPO listing and IPO listing in Hong Kong as well. Last year, their shareholder wanted to pivot to Web3. And we see that traditional trend changing massively from people who are from the TradFi. Now we see it emerging, right? We see the success of MicroStrategies and some listed company publicly in US. They're all pivoting somewhat into crypto now. So I'm joining SolarWind because they are part of my capital shareholder as well, and they invited me to help them build the Web3 platforms for their financial business. They are one of the participation dealer for the Hong Kong listed ETF in crypto, just launched early last year, for China AMC, and the one in Harvest as well. There's only 3 PD, which is participation dealer. What's very special about the Hong Kong ETF is you are able to do subscription in kind with the ETF. So let's say you have Bitcoin, you're able to subscribe with your Bitcoin. Where in the US ETF, this service is not available yet. I know they're pushing for it, but Hong Kong already have it.
Oh yes, okay, before I go to the market, I'm gonna stop you there. Alright,
Thanks, Alfred.
next up is one of our breakout managers, David. This is our first foray, and perhaps even for the C, into what I'd like to call real RWA, real world assets. We're looking at launching the fund. It's probably Q2, hopefully for Q3. David, maybe a bit about yourself.
Yeah, so hi everybody. Thanks Howard for having us. So David Kim, my latest new venture will be one of the first tokenized funds in Hong Kong, focused on luxury real estate out there in Los Angeles. Prior to that, I've been involved in the digital asset space for about 10 years, doing different things. So my next kind of like horizon, my roadmap, where I see the biggest innovation, a lot of stuff happening is actually RWA, which is kind of like what's happening out at POS. So I'd love to speak with the other panelists in regards to what's happening in that space, as well as kind of how that works between the LP's interest as a different asset class.
Thanks, David. And finally, our good friend Gavin Chung, known as the Crypto King of Hong Kong, who structured some of the earliest funds and helped some of the earliest asset managers get licensed in Hong Kong. He's just finished a wonderful trip into Seiko and is now back to get ready to work. Welcome, Gavin.
Thanks, Howard. Thanks, Howard. So I'm Gavin. I'm head of investment funds and regulations at Charles Russell Speechlys. I started the job last week. So it's an international law firm that's focused on private capital. And what we're seeing is a lot of family offices and high net worths actually allocating crypto and using fund structures. Prior to that, I was head of investment funds at PwC Legal, with focus on setting up funds, especially crypto funds, and helping crypto managers, get the licenses and navigate the SFC regulations. Very excited to be on this panel because I have two clients here, so I'm hoping Marco with his fund of funds setup, and also David on his side will be liaison.
Okay, so let's get started. Like most panels, I think we have to sort of set the stage where we are in the cycle. There's often a lot of dispute or a lot of debate about where we are in the bull market. Some of you might have heard, the 4-year cycle, whether or not we're in a left translated cycle at this time. There was a lot of expectation in both the TradFi market and also in digital assets that Feds would be significantly not just reducing rates, but starting to lighten up on the balance sheet, or at least starting a new QE phase. Doesn't seem to be working out the way people expected. Some folks getting caught off guard. So the first topic really has to do with where we are with institutional investors. With the crypto market capitalization now at roughly 3.2 trillion, which is still larger than silver, and it's larger than the British pound now, I believe. Institutional investors and crypto native family offices are seeking strategies to navigate volatility in this asset class. Since the Insto Fomo has only just begun, approximately 50 to 75% of Instos surveyed plan to increase their crypto allocations in the next 12 months. This is according to Fidelity, seeking more diversified strategies beyond just long-term exposure. Be it resolved that despite the volatility, investors are still early, and therefore a passive, long-only exposure to crypto is the optimal approach for institutional investors. Want to get your views? Let's start with Martin.
Disagree. No. Obviously, we run an actively managed fund, so we obviously have a different point of view and about a bias, let's say. But I'll just start. Maybe I could give a quick answer, but before I do, I'll give you a statistic. Investors who have passively invested in crypto over the last 5 to 8 years, let's say, have done very, very well. Clearly, they're up about 10x. That's a 40-something% annual return. That's phenomenal. However, if you adjust that return down by the amount of risk, just purely volatility, downside risk, crypto investors have underperformed on a risk-adjusted basis a passive investment in the NASDAQ 100. So the only reason they've they've done a multiple of the returns is because they've taken more than their fair share of risk. So if you are an institutional investor or a sophisticated family office, you think about risk-adjusted returns. There are different ways to invest, but on a risk-adjusted basis, one would have been better off in the NASDAQ 100 than investing.
But you'd have institutions and some folks I won't name who are like, look, we're going to be hitting 350,000 of Bitcoin this cycle. In some cases, $1 million Bitcoin in the next 5 to 10 years. So often we've been sort of pushed the buy and hold for just try our best and forget the rest strategy.
Yeah, I mean, it's certainly, if you are a 30-year investor in Amazon, Apple, Nvidia, you've done very, very well. But don't forget that this is a very early asset class. So you're taking asset selection risk. There is no guarantee that any one of these assets will be the ultimate winner or will outperform the others. We came from the traditional hedge fund world, from Millennium Management or Winton Capital. And when 7 or 8 years ago, we looked into this space about how to invest, we looked at a variety of methods, and none of them, frankly, on a risk-adjusted basis, held up relative to the top-tier hedge fund returns. So that's kind of why we start.
So let me steel man this. I'm a family office. I've been told by some of my advisors to adjust for that risk, that I should just put 2 to 5%. How can I take that approach?
You certainly can. The issue that you'll come up with, which is kind of one of the origin stories for Cambrian, is I did something like that in 2015 with a small purchase of Bitcoin. The issue is 2 years later, what are you doing? Because maybe it's gone up 3x in a bull cycle, and now it's not just 2 or 3% of your portfolio, it's a much larger percentage. And that's exactly the time where it's probably the most susceptible to a 50 to 75% drawdown, which, by the way, has happened 5 times in the last 6 years.
Yeah.
So market timing these things is very, very hard. And yeah, to get the long-term compounding from any investment, you've got to be willing to sort of go through all of the.
In fact, just to be clear, your strategy is not a market neutral, right? Your strategy is long, short.
It's long and short, and it's sort of market independent.
Right.
So
You'll make money on the short side as much as you would on the long side. Well, the whole expectation.
It depends on the market conditions. So most of the time over the last few years, we have been in a bull market regime. So our fund will make money in that scenario. Then we will drawbacks. But part of what's interesting about crypto, generally, not to pitch our fund, but what's interesting about crypto is the volatility. And specifically, I'm talking about is the tails. Or if you graph the weekly or monthly returns of crypto versus equity markets or commodity markets, you'll find that the drawdowns are far more extreme. Instead of a 10% market drawdown or 20% market drawdown causing panic, you can have a 50 to 75% drawdown in the market. And certain assets have gone down 90% and never recovered. So you can have those. But on the other hand, you can have up 50% month. So all of the interest from an investment perspective is in the tails of the distribution of crypto. So you definitely want to have a strategy, I think, that insulates you from the tails and makes money from the tails.
Yeah, definitely. I want to go into the strategies in a minute. Let's start with David first, and I'll go to Marco.
I would have to agree. So I've been in this space for quite some time, and I guess
As in, you agree with passive, or you agree in passive investing, or you agree that we need to be?
I believe you need to be active, right? So if you take a look at even the past year, when it comes down to Bitcoin and maybe the next largest coin is Ethereum hasn't really performed as well as Bitcoin.
2,600.
Yes.
2021, 2,600, 2022, 2,600 now in 2025.
Right, and that's brutal, right? So not all, crypto assets, regardless of market cap, are equal. A lot of other things. So because of other things like op risk that's tied, fundamentally to a lot of these crypto assets, is there needs to be having active as really comes down.
By off risk, it means like hacking or
Exactly, right? So unlike, let's say dealing with securities where, let's say, I guess, like a tech token like Google, if it gets hacked, you have a material impact on the stock price. When it comes down to a lot of these crypto assets, they are essentially only tech. And, heaven forbid something happens to Ethereum, right? They just had it overnight zero.
That's fine. So why don't I just put my money in a Bitcoin ETF? There's no offers there.
Yeah, I mean, I think that's exactly what's actually happening these days. Funny enough, is you actually have a lot of crypto whales that actually put money into ETFs. And the reason why is because of op risk and security risk personnel. Like, it's funny because you have these big whales promoting, libertarian views, but they also want to make sure that they don't get kidnapped. Right? So it's interesting that, the market changed that much, but when it comes down to a lot of, investors, whether it's from a family office or just an ultra high net worth individual in crypto, is they all prefer, different types of strategies, both long only on the Bitcoin side, but when it comes down to any other strategies, they actually prefer all the strategies, whether it's market neutral or long short strategies, because they understand that the game is not equal for every coin.
Speaking of multi-strategies, Marco, when you're now setting up your fund of funds, you look at where we're at. I assume actually you're going to disagree with passive investing, and then you're probably going to active. Let's dive a little bit deeper. When you look at different strategies, when I think back to the last cycle, we had DeFi farming, which was big. It generated a very consistent yield, farming some of the high funding rates as well. We also had the spot perp futures ARB, which is where you take the spot and you ARB it against the futures. And then you also had cross-exchange ARB as well, which has inherent counterparty risk. For yourself, number one, looking at the view of where you are in the market, how would you build your book today?
Yeah, I think there's concerns from LPs when I talk to them that particularly they have made from beta in the last few years that now they feel that they want to take some money off the table, but they don't want 100% off the table. So I see that, they try to diversify. Now is the time, as Martin had mentioned, that I've been struggling to think, hey, does it make sense to do active management? That have been the questions keep on asking myself every year, like 2019, 2020. But if you look back, right, I mean, I would have lost all my money with FTX if I haven't done it with my fund. I know that I'm going to go 100% leverage or 50% leverage at least onto some of the platform to trade my own allocations. And thank God, because I have some of the funds locked up in my own fund, that actually saved me from trading crazy, do something stupid. I do believe
Cheating in this industry, we call it cheating.
from the macro perspective, I do believe at least we are somewhat near somewhat big corrections towards the next 2-3 years. That's how I see it. I think now cycle got hijacked by Trump and Elon for somewhat what I call the Trump and Elon cycle. I think near the terms, closing to the terms of Trump, there will be some volatility in the market.
So what keeps you awake in that? I mean, you're talking about hijacked by Trump. Give us some texture as to what's happening in the market.
Him and Elon might go different pathways.
You're coming from the US. What do you think?
Yeah, I think that there will definitely be volatility. But I think the market is structurally imbalanced to generate higher returns than people probably expect. Anytime in history you have a lot of people with a consensus that things are going to be bad, it tends to be more often than not somewhat priced in. And I think
So are you saying that there's a general consensus that crypto is bad right now in the US? Because
I think among policymakers, there's great cause for optimism. But I think in the markets, the market participants in crypto, when you speak to them, and we see this in the leverage levels that people express their views, it's pretty subdued.
yeah, I think subdued is, I don't know, subdued is like an understatement.
Yeah, yes.
Crypto bros are down bad.
They are. So, but here's the thing. Yes, I think there will be tariff wars. There will be volatility. But the Secretary of the Treasury in the United States has essentially placed, in concert with President Trump, their goal, their measure of how effective they are is to lower the cost of the 10-year. That, if the lowering of the cost of the 10-year is achieved, then the fact that crypto is dramatically underowned by institutions, like dramatically underowned, and sovereign wealth funds, there will be some very, very material upside volatility in these markets. I think there's enough cause for all.
Yeah, and I think there's a dichotomy that our guests need to sort of remember. There's like crypto goes down bad because most are trading in the altcoin space. But then you have top 2, top 3, which is up, I don't know, like 3x in the last 2 years, right? Look at Bitcoin is just doing tremendously well, especially post ETFs. It's just a lot of investors came in after that announcement and are kind of floating in a sideways market right now.
Yeah, but that always happens in crypto. I remember before we launched our fund, CME and CBOE, so these are the option futures exchanges in the United States, the 2 largest. They had created an options futures market for Bitcoin in let's say call it 2018. And everybody was talking about, okay, well, that means that volatility is now dead.
Yeah.
And Bitcoin was at $6,000 plus or minus a few hundred. It just kept going in and around there. And of course, in the short term, it dropped 45%. And then in the long term, it went up, 15x.
People are saying the same thing now with BlackRock, right? Because if the BlackRock effect on gold, and you translate that to BlackRock effect on on spot BTC,
and in Q4, the U.S. regulators approved auctions on top of the U.S. listed ETFs, and those typically become huge derivative markets, and they increase the volatility of the underlying assets.
this is a great segue to the next topic that we have, which is about the concentration of liquidity right now and how the market structure is kind of shifted towards, U.S. markets. I was just having a side conversation with Joseph in the back there, who's from OP Group, and we're talking about Chinese government policies and how they're trying to wrestle with this shift in liquidity back to the US, specifically in Bitcoin and ETFs. So here's the resolution on the topic. Bitcoin ETFs and futures significantly impacted market dynamics compared to previous cycles, according to Bloomberg. Be it resolved that crypto native counterparties and exchanges are becoming more obsolete as AUM capacity benefits from US and TradeFi onshore liquidity. Martin, does this mean that you don't really need to work in any other exchanges? Like, what's the impact here? Can't you just run your strategies all on Bitcoin ETF and CME?
No, there's some sort of nuances that are specific to our business, which is those markets close. They're off for the weekends, for example. And the spot market in crypto never sleeps. And so there's 5 times the amount of trading minutes in a week in crypto markets, because they're continuous 24/7, as the open markets on US stock exchanges. In other words, a lot can happen when those US markets are closed.
Yeah, there's distinctly different signature of volatility overnight, Asian hours, UK hours, and then US hours, similar to FX in a way.
And not only that, if something happens off hours and the price is up or down 10 or 20%, then when those US markets open, there will be an instant correction, and you will not be able to either buy or sell. You will just eat that 10 or 20% difference.
Gamblers.
And so for us, that we manage our portfolios electronically with machine learning models, and then they adjust 24/7 incrementally thousands of times, just sort of throughout. So for us, we could never replicate our risk management.
So let me get back to this, because I want to talk about counterparty risk in a second, but let me go to Marco. You're running a fund of fund. You have a fiduciary responsibility to your family office investors, and you have the option of taking ops risk, as David pointed out earlier. Or you can have your underlying managers focus primarily on these more liquid, low, if not, non-existent op risk. Why not just invest in strategies that are in fact just trading Bitcoin, spot, on the US exchanges and CME features?
I do agree some part that the liquidity have been more centralized after ETF have launched, but I see new strategy emerging now because, as what Martin pointed out, is there's actually arbitrage between the traditional market compared to the DeFi market and also the exchange market as well. Before you talk about cross exchange arbitrage, now I actually see traditional market arbitrage between DeFi market as well. I think what I'm looking for is how they mitigate the counterparty risk towards the exchange as well, which then it will bring out to the next questions that we have about counterparty risk. But I do feel that actually once the options market of the traditional market have picked up in crypto right now, CME, because our old fund at MyCap used to trade a lot on CME, but there's no liquidity. I couldn't find any counterparty for my trade. That's a problem. Nobody is putting the order book there. Majority of the order book is still with Durbin at the moment. Durbin is still 80% of the option flow punch at the moment.
Sorry, Mark. I was just going to make I believe that because of the arbitrage opportunity, all large markets sometime in the future will go 24/7 electronic. You will not be able to run NASDAQ just pretending that your investors are happily managing risk, Monday for a few hours and Tuesday for a few hours. It will have to be at 24/7. So everything will converge to 24/7 electronic. And it's just a question as to whether Binance and Coinbase, Deribit, kind of get more and more securities and other commodities listed in their platforms, or whether the NASDAQ and other and CME, whether they go with tokenized infrastructure, whether they go, I think it'll all converge to 24/7.
Yeah, I think it was Korea and India had announced, I think India announced more recently that they would be going on blockchain and 24/7 by 2028 or 2029, I think it is, yeah.
What I've seen coming from FX trading background is the more the liquidity is fragmented, better for the market trading opportunities. So once the market got centralized before, because most of the FX are traded OTC in the interbank market, we have this system called EBS, which is formed by the interbank itself. And then once it got very centralized, we lose the liquidity. But in crypto, it's very different because we always have the huge retail market. We have the exchange market, we have the DeFi market, and then we have the TradFi market. I think with TradFi market growing, yes, it will take a big chunk of the liquidity, but it will be still scattered for some time, at least for the next 2 years, I might say. And that actually created a lot of trading opportunities within the market. And I'm happy about that because it's very different from FX, where the interbank do centralize the market liquidity, and you see the FX market trading floor just die off, right? Because once they centralize and they're dominated by big banks, it's very difficult. But I see this very differently in crypto because the retail actually have a big say. Very similar to Japan FX market. The Wanatabi used to dominate a huge amount of the FX trading market in Japan because it was just so huge, right? What I seen in crypto, which the retail guys have a huge say in the crypto market where the liquidity actually will go. And that's why you can never get liquidity away from Binance and OK, because all the little guys are actually with Binance and OK and somebody else.
I want to talk about Binance in a second, and I want to talk about counterparty risk in a second. But before I go in that direction, I want to hit regulation first because there is a link here. So this next topic has to do with Hong Kong, Singapore. Gavin, maybe give us sort of an update where we're at. And just as a backdrop here, a few years ago, Hong Kong took the second fiddle to Singapore. Singapore was very, very pro-crypto last cycle. And subsequently, it got hit equally as hard with 3 arrows as well as, FTX as well. And MAS since has become very, very strict about issuing licenses and put a high scrutiny on crypto-related asset managers to the point where even some platforms that we work with have pretty much said no to crypto. Second is taxation. There's a lot of confusion around taxation and how to deal with taxation, both in Hong Kong and in Singapore. My understanding is that SFC has kind of woken up to some of these key topics. So Gab, where are we at today? And does it make sense to start here, or should we go back to Singapore?
Although I agree that, there's this perception that there's a lot going on in Singapore. Actually, the activity levels in terms of managers setting up and doing things in Hong Kong has always been very high. And I will say Hong Kong was there first, right? I started setting up Hong Kong funds in 2017. What has changed is that in terms of regulations, Hong Kong has actually taken a very bold step with the SFC coming forward and say we're going to have this crypto-focused regulatory framework for asset management, for advisory, for trading. So the types 149 virtual asset licenses have been around for quite a while. The problem with Hong Kong is the taxation, and this problem is also there in Singapore. The problem is for monetization purposes, especially if you talk about funds, right? The tax exemption doesn't work for you because crypto is not considered one of the qualifying assets. You have to basically have a security in your portfolio in order for your fund to get the tax exemption. So even though, and that's still the case today, because crypto is not considered security, I can actually go and set up a fund now and set up my manager in Hong Kong. I don't need a license for that. I don't need the type line license for that, right? It's only if I'm an existing type line manager and I want to manage crypto above 10% that I need to get my uplift. So if I do set up my manager in Hong Kong, the problem is the fund gets taxed in Hong Kong at 16.5%, okay? The tax exemption doesn't work for me because my crypto doesn't qualify. What has changed and what will change is that the FSTB in November took a very bold step of initiating this consultation of saying let's include crypto as a qualifying asset. Let's include virtual assets as qualifying assets. Okay, that consultation finished January 3rd. We expect that it will come into effect maybe by the second half this year. Okay, what will count? There will be stuff like payment tokens, government issued tokens, stable coins, infrastructure tokens like Ethereum, Cardano, obviously Bitcoin we counted, and stable coins. I said that, DAOs. Okay, so those categories will count as virtual assets. What won't count as virtual assets will be the loyalty, SVF tokens. It will be things like limited purpose tokens, tokens that are built on non-qualifying assets. So let's say NFTs on hardware won't count as virtual assets. Okay. This opens up a whole new world for Hong Kong managers because all of a sudden you can think about actually basing your manager here, right? Do the trading, doing the fundraising all from Hong Kong under the Type 9 license. Importantly, Hong Kong structures now become available to you. So for me, right, since 2018, I would say the vast majority of all the crypto funds that I set up are offshore, so Cayman, and they also avoid Hong Kong licensing regime. They would use BVI approved managers, so onshore managers as well. Now you can actually onshore everything. And you can consider looking at structures like OFCs and LPFs, okay? Much cheaper than Cayman alternatives. With the OFC, you actually get 30% off your setup cost back up to 500,000 Hong Kong dollars. And then you have this CIES regime where, investors with 30 million Hong Kong dollars, and you get count crypto now, coming up to that 30 million threshold, investors can actually allocate 10 million of that 30 million to private OFCs, private LPFs that also invest in crypto. So as a manager, all of a sudden you have this massive universe open up for you. This puts Hong Kong leaps and bounds ahead of rivals like Singapore. In Singapore, as I've said, the tax regime is still unclear. It's very similar to Hong Kong in that in Singapore, your crypto fund won't get an exemption if you're holding crypto because it doesn't count as securities under their regime. And secondly, for the vast majority of crypto managers who set up in Singapore, yes, they do get the MAS asset management license, but that is still primarily a securities license. And what they do is they have a condition imposed with the MAS says to them, you cannot allocate more than 20, at most 30% of your AUM into crypto. So for a lot of these managers, all of a sudden Hong Kong becomes a lot more attractive.
So yeah, I'm remembering a conversation you and I about a month ago. Gavin has a beautiful chalet in Niseko. He invited me down for a couple of weeks, and he took me out to dinner. Last call, he said, was 9:30. Turned out the restaurant's last call was 9 o'clock. They didn't let us into the restaurant. We ended up going to 7-Eleven across the street. They had a dine-in facility, and the two of us sat there eating a cup noodle, and he drew out a map about Hong Kong and BVI structures.
And I'm remembering that conversation now as we're solving world hunger and cancer. I was at 10:30, 11 o'clock at night, and you were explaining to me the kind of a migration effect that you see, where a lot of funds are, to sidestep some of the Hong Kong regulation, they're creating fund-of-fund structures. Can you explain to me, maybe for the group here, how that might be changing, where you start with a fund-of-fund structure, offshore BVI, and do you see that now coming back to Hong Kong?
Yeah, they try to get around that because a fund of funds fundamentally is still a fund of securities, because interest in other funds are considered securities under the SEC regulations, right? So for tax purposes, that solves your issue. Your fund will get a tax exemption. The problem is the Type 9, because the SEC says if the underlying is also VA, then your traditional Type 9 is not good enough. You will need to get the uplift. So in 2019, actually called Diginex, Group of Diginex get their focused Type 9 fund of funds license. And that it was a traditional Type 9, but SFC imposed additional conditions in terms of the way they do their underlying DD, that the process that they have risking funds. I think now with the opening up this tax regime, people might think, well, okay, fund of funds is great, but if I actually want direct exposure, I want better control, I want better liquidity, they can actually go into direct.
Marco, you have regular conversations with SFC. Why don't you walk us through what they're thinking? I mean, we're in the middle of applying for our own virtual assets license. I know Martin is thinking of joining us in Hong Kong at some point. What does it look like if you're to schedule building out your license today, and what is SFC's approach to it?
I think it's just human resource at SFC is not enough. I think there's a long queue for people who want to apply for the uplift of the Type 9.
So we're talking like 6 months, 9 months.
Yeah, I hope that a few apply as well. I think because of the different licensing regime, we have the Type 1, Type 4, Type 9, and then we have the VATP, which is a Type 7. I think plus the one, there's a huge lineup, a huge workload that they have. It's not that they don't want to approve more, it's just the time that they need to look at your applications from the uplift to make sure the RO is experienced enough in this industry. Because in Hong Kong, when the local cost of license is about 2,000 Type 9 license, there's about 1,000 Type 1 license. Think about if they all apply.
And for how many crypto licenses do we have now?
About 30 uplifted now for Type 9.
Yes.
Most of them don't launch a product, they only get the uplift. Type 1, there's about only 30 of them as well. So I think the problem, if you guys already have to receive the questionnaire from SFC, then you understand, because that framework, my team from My Capital and I have whole consult with together with SFC to come up now with the similar questions to ask about question like your operational, because I think launching a equity fund is much simpler. Right? SFC just look at through, you guys are good, you guys have gone join. In crypto fund, very different is where I think our next question is, they massively worry about counterparty risk. I think that's a huge and operation risk that they look at, because at the same time, my teachers are all at Hong Kong SI for how to get that portfolio set up. And I think a lot of the traditional finance participants do not face counterparty risk issues. So if you have Hong Kong EX, there's actually no counterparty. Right, custodian, you don't have custodian issues with it. But I think with crypto, there's so many operational risks that SFC risks, and those are real cases. As you have seen that family office or funds have got hacked or got stolen.
So let me hold you for that. I'm going to come back to this, but so Gao, from your experience of helping managers sort of set up, counterparty risk is a pretty big deal from SFC's perspective. The way they structure the questionnaire almost feels as though they don't want us to have any wallets or self-custody.
Yeah,
that's the case?
Yeah, self-custody has been red flag with the SFC, and they will expect in that case if you were to go self-custody. They're not saying no, but they expect your disclosure to be extremely, extremely thorough. Okay. So to Marco's point, what we do is when new managers say, oh, we want a Type 9 DA, we tell them at least 9 to 12 months.
Yeah.
Conservatively. And so the development of tax side is great for Hong Kong, right? But my one caveat is that you then need to use the Type 9 VA. You need to start relying on it for your fund. But then you have to think about SFC, right? Because they will want to know everything about the product you're launching. And when I say product, I mean every new fund that you launch. So if you have an umbrella SPC, every new SP basically have to go through SFC approval. And they will ask questions like, what are your custody arrangement? What's your wallet arrangement? What sort of coins?
So with things like RWA, for example, they're not going to be listed on exchanges. RWA is going to be issued directly from the issuer.
Yeah.
Number one, are these still considered tokens and still considered virtual assets?
So security tokens will sit outside of virtual assets, but they'll be regulated like normal securities.
Okay, so for the fund that we're doing with David, for example, that's not going to be considered virtual assets.
No.
Okay, that's great. So that means if we're going to RWA, these are considered tokenized assets. It doesn't fall under, and pretty much anyone can do it. Okay, so I want to talk about counterparty risk. Counterparty risk is something that has been on everybody's, on everybody's radar. We've had roughly about $2.3 billion in hacks in the last 12 months. Not that much, to be honest, considering crypto. But then you also had the Libra token, which got rugged a few days ago. $107 million got rugged from the market, and this was promoted by Nile, the president of Argentina. I think they're trying to work on a case against him for that. So I want to ask Martin first, when you look at just sort of like the risks about this, and there's two things I want you to talk about. Number one is counterparty risk as a hedge fund, right? And you're very unique in that sense. You worked with Coinbase. Coinbase turned out to be a big winner after Luna and FTX because they were operating very much like a prime broker. And this is not something that many other crypto exchanges know how to do. As in acting like a prime broker, working on terms with their institutional investors. And number two, I want to talk about, the portfolio, but let's start with the first one on counterparty risk.
So I think if you are a sophisticated family office and or an institutional investor, you should approach counterparty risk of the managers, or if you're directly investing, the same way you would in any other asset class, which is to say, are you getting compensated for that risk? And ask yourself intentionally, can you quantify that risk? Because that's a necessary precondition to figuring out if you're being compensated. If you cannot quantify the risk, you are not being compensated for that risk. And so when we looked at this space, kind of getting into it from 8 years ago, we basically said, these are unquantifiable risks, these counterparty risks. So unless you can underwrite the creditworthiness and the operational controls of your counterparties, we will hold them to the same standards we would if we were dealing with Goldman Sachs or JP Morgan as brokers or primes or custodians. We hired consultants from that world who are experienced in diligencing prime brokers like Goldman and Lehman and everything else. And we set them loose on this industry. And basically there was one firm that came up that would pass, and that was Coinbase. So one of our consistent goals year in and year out is we will not lose $1 to counterparty risk. And I think
Can you give it one same strategy? Can you give one or two features about Coinbase that differentiated it from, say, OKX or Binance, etc., besides regulation?
So the main one is the transparency and availability of the information that's necessary to do the diligence. If they are a public company, they have audited financials, they, on a quarterly basis, provide transparency to their public investors. They are underneath penalty of imprisonment for fraud under the U.S. Department of Justice. So that is a company that is set up to provide transparency. Now, can they have publicly traded top 4 audited companies been frauds? Yes, Enron has. It does not guarantee anything, but it means that you can do the work. When we tried to diligence FTX, we could not get the information from them that was necessary to do the work. Therefore, we turned around and said, we cannot work with you.
So let's talk about Binance. And I think the reason I want to focus on this, one of the more consistent topics that I've heard is about liquidity versus counterparty risk. Binance has the deepest liquidity globally, and yet it's been on the front page news when it comes to legal challenges. CZ himself just came out of jail. All hail the king. Maybe I'll start with Marco first, and I'll go to Martin. Marco, when you look at managers and you know yourself that Binance has the most liquidity, let's say they're running an ARB strategy, etc., would you say no to a manager who's trading off Binance, or would you make an exception?
I wouldn't say no, but I would look at, because I think post-FTX, there's massively changes in the industry, where before I think we directly face Binance. Right now, I think we have imposed some of what we call tri-party agreement within the industry that I do not face, or the fund do not face counterparty risk directly. It's custodian with maybe Copper, Kimanu, and some of the custodian, which is backed by Nomura and some of the investment bank, that we feel more comfortable. So I think that is one massive changes. But coming across, there's still a lot of funds who come to me, and I think 80% of their counterparty risks are still with Binance at the moment, which I think that have to change, slowly migrate to the tri-party agreement that we have.
Martin, what do you think? I know we've been talking about Binance before as well.
Yeah, a couple of points. Binance is probably a safer counterparty today than it ever has been in the past because it is under a surveillance agreement with the US government. That being said, I agree with Marco. The industry today provides alternatives to directly posting your capital and pre-funding trades on Binance. And you should avail yourself of it as a fund manager, and you should insist on it if you're a limited partner in one of those funds. And the tri-party agreements are a good. But then you need to diligence the custodian who is essentially forming. I don't know if everybody knows what a tri-party agreement is, but is essentially you, the asset owner, are here, and you want to trade with, let's say, Binance here. And there are a couple of ways to do it. One is you can put your money with Binance and then trade it, sell it, put the capital, and then buy and trade and settle, and then
Fully funded.
Fully funded. That's one way. That's the traditional way in crypto. It does not work this way in equities because it's all of these things are separated so that you don't get, pardon my French, screwed.
Yeah.
So that's kind of one way. The other way is you don't put your money with Binance, but they extend you credit and you can trade and then you settle. So I say, I want to buy, you'll give me $10 million credit line. I want to buy $10 million of Bitcoin. They do it for you. Then you send your 10 million in cash and they send you the equivalent in Bitcoin. And that's a credit line type of arrangement. There's some of that. But then the other one, which is safer kind of for both parties, is that there is a intermediary, let's say a bank, that's the third party, and they are holding, let's say the fund manager's cash in an escrow account, kind of, for Binance to know. And so when you go to trade, the settlement basically gets done through this other trusted third party who has a balance sheet that's rock solid. And that was not available in crypto many years ago. The whole space is moving that way.
I do want to sort of tap on David as well. As you've been in this space for a while. You know all the shenanigans that happen in some of these exchanges. Do you have a view on where we're going with counterparties?
Yeah, so I think when it comes down to counterparty risk, it's quite important. Obviously, liquidity as well, but even if you have counterparty risk kind of settled, you could still have risk, especially in the crypto industry. So often now, even if you get a line of credit, what if your line of credit is vulnerable and exploited, right? So in addition to checking the boxes on both counterparty risk and liquidity, again, it really kind of ties to pump risk. So a good example is, I guess, like the FTX situation, where a lot of people were trading on FTX, they had accounts, etc. And a lot of funds, in addition to any sort of reassurances, they should have at least had 1% on the fund monitoring what's happening in the network, right? So in TradeFi, sometimes you have these events where, like, let's say the ship gets stuck in Suez Canal and financial markets freezes. Well, the crypto, that happens actually on a monthly basis. So if you actually had, like, let's say if you were either your market neutral strategist or market making, if you're actively monitoring the network, right? And days in advance, if you see a market maker pulling a $500 billion clips, that should red flag you. So I think when it comes down to, especially when you're dealing with a lot of assets in crypto, I think first and foremost, counterparty risk, liquidity, etc. But again, because that the infrastructure is widely different and it's vulnerable, just kind of like cybersecurity attacks to tech companies.
But you mentioned a great sort of counter to that, which is monitoring on-chain activity.
Yeah.
Right. And there's a lot of teams who are TradeFi actually don't monitor on-chain activity as much as they possibly could. So you are a family office as well. Do you have a recommendation? Should we have that as a requirement? Does your team monitor on-chain analytics as part of your investment due diligence?
And I do. Like I've been in the space for quite some time, and then so I kind of take a look at a lot of the stuff that's happening. And there's new tools out there that are getting better and better. For example, there's a tool called Arc Intelligence, which basically has all the funds that are out there, like for this BlackRock fund, etc., where you can see all the on-chain transactions that are flowing. A recent one that popped out because of the whole meme coin phenomenon is basically bubble maps, where it does like the mapping real time of concentrated liquidity and things like that. So I think when it comes down to more active management, it's quite important for a lot of managers to actually use some of these tech platforms to put a checkbox next to op risk, because I think unlike traditional markets where maybe you have more periodic reviews of like how the change is doing, I think when it comes down to crypto specifically, it's a 24/7, and there's situations that on the infrastructure side it affects that indirectly impacts your pricing. That I think that it makes sense to you need to continuously monitor the change, even if it's Coinbase, right? Even if it's Coinbase, things can go wrong, and that would be kind of like what I would be looking at as an active fund manager, or even as an investor in addition to the other good stuff.
I want to sort of pivot to RWA right now. So maybe let me ask out, and just to set the stage, there's a love-hate relationship with RWA because everyone talks about how amazing the world will be if we tokenize all real-world assets. The exchanges are really excited about RWA because they want to transform their exchanges and TradeFi. But those who are in the crypto space are not really that excited about RWA because the returns on real world assets don't come anywhere near sort of speculative crypto assets. So how do you reconcile that? So maybe for Gab, in terms of the activity that you're seeing on RWA, what's your view here? And
I'm most active with David because I'm one GTM fund. I remember 2017, people come to me with buildings in Laos and Cambodia saying, hey, let's tokenize this. Because, and I think this still persists today, people think that tokenization is the magic wand that will give you instant liquidity, right? But it doesn't, because the people who you want to sell your tokens to are not stupid. And they will know, like, if you underlie is a liquid asset, just holding those tokens is a minimum code to suddenly make it liquid. Right? So yes, a lot of buzz in the market, and it comes in waves, right? But I think there's biggest challenge obviously regulations, and then how do you actually implement, how do you document it, how do you tokenize an asset, rather than ensure that there's no double counting in terms of like shares and for example, we tokenize funds. How do you separate out shares and funds from tokens representing core shares, right? So there's still challenges, drafting challenges there.
and do courts recognize ownership of token holders?
They recognize the contractual. So the way we do it at the moment is, so what we say to a lot of people who want to tokenize RWA is to create a fund, right? Get the fund to hold the tokens, then all your infrastructure does the fund documentation is there, and then you tokenize the interest of the fund. And that mechanism is basically structured products, right? So we're just creating structured product onto all the fund yields. And that contractual relationship has its precedence in the court. Courts recognize it.
Okay, so these are tested.
These are tested. The challenge is now, it's like Singapore, for example, is looking at directly tokenizing VCCs, right? So the VCCs will at some point be able to directly issue tokens rather than shares. And then I think Caymans and the BVI, they are looking at doing that as well. But I think that's going to be a bigger step, because then you need to have a bigger precedent. You need to have a court and say that we'll recognize these tokens and same as we recognize shares on share registry.
David, so to the Gap's point, why set up an RWA fund? Why tokenization? And is there liquidity, you think, for this asset class?
Yeah, so I think when it comes down to crypto as an asset class, a lot has changed in the past 10 years. So a lot of people refer to crypto as an asset class, but now crypto is 2 trillion market cap. So within crypto, I think there will be individual asset classes. When people say Bitcoin as crypto, I actually don't even really consider Bitcoin as crypto anymore because there's not much on-chain trading happening. Pretty much 200 bills and ETFs and private companies, etc. So it's grown so much that even within crypto, I think there's going to be new asset classes. And I think the next new asset class that's not been coming is RWA. I think when it comes down to this stuff, it's just impossible to time things. But, BlackRock, for the Allocating being all active, I'm optimistic. That's kind of one of the reasons why what Gavin mentioned is right now, from an infrastructure perspective, entitlements perspective, regulatory, it's behind. Right, they're not ready yet, which means that if you want to tokenize anything, structurally, probably it's just easier to kind of just grab a fund versus the underlying security because the regulations frameworks down our debt. So it's going to happen, yes, but that's why at least personally, I've gone ahead and just set up one of the first tokenized ones. It's not from the underlying security.
Okay, so I'm an investor, right? So I'm a family office. I'm talking about it, and I'm like, okay, this looks interesting. So why wouldn't I just go and buy a collection or a property fund in LA versus a tokenized fund structure?
Yeah, so the honest answer, and because I've been to a lot of these seminars and the lawyer meetings and all this kind of stuff, I don't think there's any benefit to tokenizing an asset today. Like there's no liquidity today. Right. However, at the same time is people will ask me, why did you pay extra money to tokenize your fund? There's no one else is doing it. Nobody wants to spend the extra amount of money because there's no benefit.
Yeah, that's expensive.
Everybody in Hong Kong is expensive, right? So,
But at least to call me at any moment.
yeah, so no one, again, like everybody in Hong Kong especially is quite interested in tokenization of assets, but nobody's doing anything about it because they want to keep it up.
Yeah.
And they asked me that I tell them straight up, I'm like, there's no benefit today, there's no liquidity today. So they're asking, why did you do it, right? So for me, it's kind of like, from a timing perspective, I think that it's a lot different than 2018. I think when it comes down to macro, whether it's tokenization of real estate, tokenization of private shares of companies, etc., the culmination of what's happening kind of in financial markets, again, that the base selling point is unlocking liquidity. But in order for you to unlock liquidity, you could inject liquidity, right? And some of these Wall Street firms have been tokenizing, bonds, etc., but they're not injecting liquidity. They're just creating wrappers. Yeah. So the question right now is using the money, right? And it's a unique time in crypto because in the crypto industry, you have a lot of money, right? So you take a look at Tether, how much cash they have on the balance sheets and profit. Take a look at Binance. So a lot of these...
And Tether makes more money than BlackRock does.
So they pretty much now own the crypto space. They make a lot of money and they want to make more money, right? So if you take a look at TradeFi, how big is that market? 200 trillion plus. So they're thinking, okay, how do I get a piece of some of the TradeFi stuff? And the TradeFi people are figuring out, okay, how do I need to exit, right? Some of these packed shares with VCs, even when it comes down to real estate. So for the first time in the past 10 years, that's created a situation where there's a trade-off, a win-win type of situation between crypto as well as TradeFi. And that's why I think from a timing perspective, it kind of makes sense with things that are happening this year, next year. Obviously, you have Trump administration pretty vocal, right? The DeFi, as well as the recent conference in New York with Ondo, where pretty much all the top bankers were out there. And again, fundamentally, BlackRock, one of the biggest guys, he's been promoting Bitcoin ETF before ETF, and it's under 3x. And right now, every commercial or interview, he always talks about tokenizing securities.
Yeah, I think, and I totally agree. I think it's kind of like once you have these larger institutions getting into the game, I think your launch is about future proofing because the moment the rails are in, the same players also have control over distribution and therefore liquidity. And so if the marketing engine starts to switch on, as it did for Bitcoin, into RWAs, then I assume that we'll start to see liquidity come to the space, especially when we look at the external asset managers, look at the private bankers, and they can see that potentially there's a liquid framework and an exchange that could trade VC investing, RWA assets, etc., more than just green bonds and UST bills. That could be really, really interesting. Yeah. Marco, any other final thoughts on RWA? And would you invest as part of your fund of fund?
Yeah, funny enough, in 2020, right? So we actually tokenized one of our fund. But yeah, same problem where David, I think tokenization does not do anything to create liquidity. I think just putting a wrapper around it, we just want to prove the concept it works. 2020 is too early. I think now is a good timing because the benefit of RWA in crypto is for people who do not want to go off-ramp back into traditional asset.
Right.
It's actually connected both well that people who have Tether or let's say they have stable coins, they want to park it somewhere that they don't want to off-ramp, then go back to traditional asset that actually, have less friction in the on-off ramp.
So these are the crypto bros who make tons of money over the last 5 years. They don't want to off-ramp. This could offer a great opportunity for them to switch back into real-world assets rather than stay on the speculative side.
We have already seen that. So although some of the tokenizations and also the real-world assets platform have actually grown a lot, and I see that because I think right now interest rates are relatively high in the TradFi market, and that's why people will now wanted to go that way. I think that create more liquidity, or people, as you mentioned, I 100% agree that once these big players are in, they will actually drive the distribution network as well. That will actually drive a lot of the interest from that aspect. The other one that I'm looking for, which recently on the news, is the tokenized asset become a collateral for trading in the real world. We have seen five brokers accepting tokenized asset as a collateral for DeFi trading or for traditional trading as well, which is a big improvement. But I think that is a way that's showing that, okay, this asset as a collateral are recognized across the board globally if you tokenize it. So it make it much easier to go for the DD and valuations. It saves a lot of time.
I want to ask one more technical question here about DeFi. A lot of you who are here for a couple of cycles will remember that DeFi was the big thing the last cycle, and then there's the Luna crash, which pretty much destroyed any semblance of DeFi. I'll start with Martin first. I know your fund doesn't invest in DeFi, but is there anything interesting in the space that might make you decide to pick it up, especially if we move into the bear market? And currently when I think of DeFi, all I can think of right now is maybe like Ethereum at 3%, I think it is, in terms of the yield. But outside of that, that's pretty much it.
I'm of two minds about DeFi. I think conceptually, I'm really excited about it, interested in it, I want it to succeed. And it's because the central premise of a lot of innovation in the crypto market is to enable permissionless, programmable methodology of transferring value around across the internet among people without going through an intermediary, like a Visa or a bank. And so DeFi is a better expression of that original intent than a BlackRock Bitcoin ETF.
Yeah.
It's just
It's the antithesis, actually.
Yeah. But I'm happy that one of the Abu Dhabi sovereign wealth funds invested in the BlackRock Bitcoin ETF. But on the other hand, currently, there are a lot of regulatory and other risks that would prevent us from trading.
Custodial is the first one, right?
Yeah, for us, self-custody is a non-starter. And you constantly read of the issues that are there, that even sophisticated players have lost principal capital, which again is kind of one of our bugbears. Like, more there's the AML KYC thing of like, who are you trading with? You hope they're a good actor, but you have to ensure in our regulatory regime. So it's probably outside of our map rate for now.
Yeah, for regulated manager, it would be very difficult to access DeFi. That's one of the questions that is imposed by the SEC that they would ask you.
Forget it.
Whether it's good right now, but I think it's good because it's created another liquidity pocket. It's a big pool of liquidity.
Yeah.
And imagine putting the entire P2P market where I think China used to be a huge P2P market. Imagine that P2P market going to DeFi. It's a huge liquidity. And I think it's incredible.
Making like GMX, Hyperliquid, these are all two decentralized exchanges that done very, very well in the last year. I mean, you can have a look at them. A lot of them are trading speculative assets, but they're growing by the day.
Yeah, I think DeFi is a growing pocket. So I want to see, as Martin has seen as well, I want to see this area successful because there will be player that is not regulated, like prop trading that will be able to access both TradFi market, DeFi market, and they will be able to trade arbitrage and around both the.
Yeah, do you see anything that SFC is doing to promote DeFi, or are they just flag out?
Well, I think DeFi scares the SFC.
Yeah.
And I think the trend you see is that regulators around the world, because regulators all think in the same way, which that they kind of work by analogy and parallels, right? So DeFi kind of really baffles. We've had discussion where they say, well, in the staking relationship, is that like a deposit, like a back deposit? And then you have liquidity tokens, right? Mining liquidity tokens, and you have these tokens, and the SFC, well, is this an equity? Or is this debt? And they just have no idea how to approach this. And that's why for regulated funds, they absolutely say no DeFi, is we don't understand it.
I'm good for DeFi. I think first and foremost is the counterparty risk is your liquidity pool, which is basically all the other participants. So it's not for everyone. It doesn't work. So, I mean, if you take a good example is you take a look at Ethereum Foundation, right? They've been around since the beginning of time, and they weren't even trusting to participate in their own ecosystem. They only did it 1 month ago, and that's because of all the heat that the Ethereum Foundation has been dealt with, but it took them like over 5 years to participate in their own network. That kind of shows you in regards to what they feel about the counterparty risk. So, however, how I imagine things happening is I think there will be what you call institutional DeFi. So if you take a look at some of the biggest DeFi platforms like Aave, Tesla Good Time, etc. But the tricky part with Aave is that it's not KYC, right? So I wouldn't be surprised if you take a look at some of these DeFi platforms, they have licenses in like UK, etc. I wouldn't be surprised if they launch a new product, which is kind of like institutional DeFi, where all the liquidity pool participants are actually like KYC, walled guarded investors, walled guarded, and that's where RWA has a play with it as well. But like the way that it works today, it's not really for everyone. There's some counterparty risk, but I do think that Wall Street actually sees the huge benefits of what exists. It just needs to be regulated for, and then it'll come and play. That way, in case there's like some event, they can kind of figure it out.
So we're coming up to the end of the hour here. I think we covered a lot of bases. Any questions, first of all, for our panelists before I give them the final word? Oh, I do have a question for David. Any meme coins that you can recommend for us? Alpha.
So I spoke at the out of the quants
That's why we're all here, by the way.
last year at Fidelity. I got to invited me, and then they asked me this. I was a moderator, and they asked me the question about, what should I buy? And I didn't want to say anything because obviously it's sensitive. But like at that time, like I said Solana, right?
Yeah.
And I told the audience, like, often a lot of people who are not in crypto tend to overcomplicate things. And then my reasoning for why Solana was, you take a look at the cap table of who Solana is. Take a look at some of the team members of Solana. It's similar to like Binance. There's pretty high pedigree people from the Ivy League, etc. So it's to answer your question, after the Libra event, I do think like when it comes down to meme coins, like if you take a look at any sort of trend, etc., you had one of the most powerful persons in the world launch a meme coin, which is Trump.
Yeah.
So you have to ask the question like, what can top Trump coin? And I can't think of another meme coin that could top Trump coin. So for me is, when it comes down to meme coin industry, especially after Libra, I don't really know. There's a lot of investigations that are currently going on with past 48 hours in terms of advisors, etc. So that will all kind of come out. So I don't know about deep coins kind of going forward.
I'm reminded, Martin, one of our earlier calls, I asked you, what would you trade? So I would trade anything top 20. Yeah, we have an allocation for that. And when Trump, a coin, hit $7 billion, I was like, oh, I wonder if Martin's trading this right now. I wonder if it's in his book. Should I see it on the next quarterly report?
I can honestly say, I don't know if he did. It certainly wasn't one of our top holdings at any given point in time, but if it's liquid, we could trade it. Yeah.
Questions?
Can I just say, as David's lawyer, everything my client just said, just that does not constitute financial advice. You mentioned tokening. It's just a lot.
Well, I think that's a wrap, guys. Thank you very much. It's been really good. Enjoy the rest of your week here at Consensus and Consensus Week in Hong Kong. We're really excited. Give us a call, give us a tap if you're looking for setting up a fund or you want to meet Parton and the rest of the team. Give me a call and we'll see you on the next one. Thank you.
Thank you all.
Thank you.